Hi, everyone. Sandra here with the Mortgage Center. Thanks so much for joining us today. I hope you're going to have a great day. So let me just kind of give you an idea of what we're doing today, and I'm just going to stop sharing this so you guys can see me. We've got about 20 people registered, so I'm just going to get started because I want to respect the folks that have arrived early. I thought I'd spend maybe about 15 or 20 minutes just going through some of the top 5 questions that you as realtors need to be asking your buyers and your sellers alike about making sure that they're prepared financially for being able to put an offer on a property, because I don't need to tell you that you got to act quick in this marketplace. So you want to make sure that your buyers and sellers are financially prepared. And then I wanted just to review at the end a little bit about what's happening around mortgage interest rates, and chat with you a little bit about sort of some of the new changes that the government is proposing about the stress test rate and how that's going to impact people. So again, it's about 11 o'clock right now. We'll probably get through most of this stuff in about 30 minutes. And so here we go. So let me share my computer screen. And I also did want to mention to you that I think we've got about 16 people on right now. If you do have any questions, if you could just include them in the chat. And what I'd like to do is I'm going to, after I kind of finish the main part of the presentation, I'll try to go through most of your questions and answer them. And then, as I said, in the last like 5 to 10 minutes, we can have a quick look at what's happening with mortgage interest rates, and then just also cover off what's happening with the proposed changes to the stress test rate. Okay, so again, I love answering questions. Just include them in the chat and I'll deal with them and I'll answer them all at the same time, sort of near the end of the main part of the presentation. So let's get started. I don't know about you guys, but I love meeting people on Zoom. And I can tell you that we have not actually physically met a customer in person since February 2020. And it's been a really interesting experience with us because we were actually we were probably meeting 10% of our clients online anyway, for various reasons. And the main reason was, we deal with families who are moving and we just wanted to make it convenient for our clients. But we've actually had some really amazing feedback from our clients in the online appointments that we're having. And we actually had one of our best years ever. So I just love meeting with you guys in this kind of format, and just adapting to the new normal that we have because of the pandemic. So let's get right into things and look at some of the top 5 questions to know. So some of the top 5 questions you need to be asking your buyers, so you know that they're ready to purchase a house, whether or not they're buying and selling or first-time home buyers. So the first question I think would be obvious. When and how did you get pre-approved for your purchase? Okay, so let's have a look at this, because I always get the panic call the day before financing is due saying I was pre-approved for the mortgage, now the financial institution won't give me the financing. So let's look to see what's actually happening. There are a lot of online pre-approval calculators. We actually have one ourselves. And people think that they're pre-approved for a mortgage, but they're not, because all the pre-approval calculator does is it pre-qualifies a client and gives them sort of a baseline on how much they can afford. And what I find with a lot of these online calculators, and they may have actually even spoken to a person, but people overestimate their income and underestimate their debt. So one of the things that you need to be wary about is if you obviously have a client that says, hey, I've done an online calculator, even if you ask them, have you talked to somebody? Even if they say, I have talked to somebody, I can tell you that a lot of people do not want to take the time and effort effort that's required now to actually do a good pre-approval. And that puts you at risk, obviously, as a real estate agent, because when you put an offer on a property and there's no condition of financing, and that file is not going to be closing, or that purchase isn't going to be closing, not only do you feel bad, but the clients are in a really terrible financial situation. So most people right now know the fact that they need to get pre-approved before they talk to a realtor. We have probably done more pre-approvals than we ever have in the last 5 years, just because we've got a huge cohort of millennials wanting to get into the housing market. So just be wary a little bit about those auto pre-approval risks. You can always say to your client, listen, I always recommend getting a second opinion. Do you mind if I connect you with the mortgage professionals that we work with? I always, when I'm doing a pre-approval with a client, I'm always asking the borrower, who's your realtor? Do you have a realtor that you're working with? And obviously, if they say yes, I always ask the borrower to do an email introduction to the realtor, just because the way that we position it is that when the realtor and the mortgage professional are speaking, it benefits the people who are buying the house. So there have also been some changes to pre-approval, the pre-approval criteria. So if you have been working with clients who are pre-approved and they do not have an accepted offer before June the 1st, they may want to revisit their pre-approval, because some of the changes are related to the stress test rate. And again, I'm going to talk a little bit more about that. And those changes to the stress test rate will obviously impact their ability to qualify for the mortgage. And then the other thing that often comes up, especially in a pandemic, is a client's changes to their employment. So some of your clients, some of your sellers may have actually been on CERB last year, had reduced income. So you need to make sure that, it's not your job to do that. It's our job as a mortgage professional to sort out all of those changes to employment and make sure that we know exactly what their employment status is, what their last 2 years of employment status was, and how that's going to impact their mortgage approval. This is not just for first-time home buyers. I have had a lot of people who currently own a house who are selling, whose financial institution has declined them for the mortgage because changes in employment or even changes to credit history, especially for those people who may have deferred mortgage payments last year. So the next question you should be asking, or you bring it up, because we certainly bring it up, is sometimes appraised values are coming in below the agreed upon price. If that were to happen, would you have a backup plan? So we are always talking to our clients about a plan B. Sort of like, what's the worst case scenario, and are you okay with the worst case scenario? Because almost all of our buyers that we're currently working with, regardless if they own a house, have to put an offer on a property without a financing condition. I think the last 10 offers that I've seen for purchase agreements, only one had a financing condition, and I think that person was buying, I think, in London or Chatham or probably New Brunswick. I just helped somebody buy a property in New Brunswick. But so let's look at this question. So do you have a backup plan on a low appraised value? One of the things that real estate agents used to do, and I know some of you real estate agents have been in business longer than I have in mortgages, and I've been doing this for 20 years. Mortgage verification was sort of in fashion for a while, especially when sort of depreciation in home values went down, because realtors were asking for mortgage verification, obviously to ensure that there would be enough equity in the property to pay the real estate commission, right? But I would encourage you to, start thinking about doing mortgage verification, because I can tell you, like, we know all of the liens that are registered against the property, but many people just in the last couple of years have gotten second mortgages on their properties. And even as properties rise, people have outstanding CRA debt that they need to pay, and there might be a lien on their property because of that. So one of the things that I would encourage you to do is, if you're not in communication with the mortgage broker that your sellers or your buyers are working with, you can start the mortgage verification process. First-time home buyers are actually impacted more on low appraised values. Now, let me just kind of talk to you a little bit about this. It is probably less than 5% of the cases that we work with, or the clients that we work with, actually have a low appraised value. It is very rare. And especially now, we've had a really good 6-month run of purchases that have closed at high values. So when an appraiser is doing a valuation on a property, typically in Guelph, Kitchener-Waterloo, Cambridge, so more urban areas, again, we are finding that appraised values very rarely come in low based on the purchase price. And the other thing to kind of layer on top of this, sellers are having more equity and more money to put as a down payment. So low appraised values are very rare. Oftentimes people have enough to cover the difference if it's required, which is very rare. But for many of the first-time home buyers that you're working with, I am finding that the default insurance providers, which is very rare, are asking sometimes for appraisals, even though the mortgage is insured against default. So with first-time home buyers, one of the things that we do is we obviously talk to them, especially if they're putting less than 20% down or less. Do we have a backup plan on a low appraised value? So remember, you also have to talk to the client about the difference between the listing price and the purchase price. And so that's why I think that's where you, as a good realtor, your knowledge and your information can help alleviate some of the concerns that the client has about a low appraised value. Obviously, we talk to them about that, but it's important when the realtor and the mortgage professional are working together to help the client. I also wanted to let you know that we have had many first-time home buyers put offers on properties where there is an appraisal required, and it's not necessarily the valuation on the property that's the issue. It's the condition or the location of a property. I think I probably had 5 or 6 people call me about a property in Guelph, and it was it was a great location, but it didn't have any kitchens or bathrooms in it because it was just sort of in the process of being renovated, and it looked to me like maybe just somebody got tired of doing the renovations. That is going to be an issue with financing, because unless there are kitchens and bathrooms, the condition of the property can be an issue. So remember, the appraisal, the main function of the appraisal is to verify the true market value, but it also has quite detailed pictures about the condition of the property, and there's also a condition report. It's not an inspection, because remember, inspection is related to the structure, but it's not just, the appraisal can have 2 impacts on the financing. The first one is if the appraisal comes in low, and then also the condition of the property. And as you know, many first-time home buyers, if they're looking in a purchase price for a detached house for under $500,000, that property is going to be a fixer-upper, especially in Guelph and the surrounding area. So the third question is that you want to ask your sellers here is, do you have to sell your home in order to buy the next one? do you have to sell your home in order to buy the next one? So let's look at some of the behind the scenes on that. So we're talking now about bridge financing. So how does bridge financing work? This is one of the most misunderstood financial concepts when you're buying and selling. I can tell you that buyers and sellers do not understand this concept. We obviously talk to them about it. So the bridge loan is the loan for the down payment. Okay, so what would happen is someone's buying first and they're selling at a later date. And usually bridge financing is usually up to 4 weeks, on an exception basis, 6 weeks. So remember, bridge financing is the loan for the down payment because the client is buying first and then selling later. And so they're expecting the proceeds from the sale of the house for the down payment. And in this case, you need to have a firm offer on your purchase and the firm offer on your sale. So I think in this environment, most people are putting offers on properties without a financing condition and probably without a sale of home condition, with the hope that they will be selling their house and that offer that's going to be coming in is going to be firm on their sale. Right? And so I tell clients, like, if you do not have a firm offer on your sale 3 weeks before your closing date on your purchase, we need to enact a plan B. Okay. The other question I think you should be asking people around, do you have to sell your home to buy another home? We have actually helped a lot of people move into Guelph who might be selling in the GTA or outside of the Guelph area, Kitchener, Waterloo, Cambridge, Fergus, Elora, Arthur, Mount Pleasant. So what happens if you are helping an out-of-town buyer who has a home to sell in another city? And I'm actually finding myself in a situation, a couple of situations like that right now. So you want to make sure that as a realtor, it's fine for you to go ahead and help that client buy a house, but what is the circumstance for them to sell? And obviously you would talk to their real estate agent who's helping them sell the house. I'm also finding that a lot of our buyers are deciding to keep their home. And so we have, we've been in business for 20 years. We have thousands of people who are looking at houses or who own houses that are appropriate for a rental property. So this is a really great opportunity for you as a real estate agent because these clients are actually moving up, but they don't have to sell a home. So you don't have to, well, obviously you would, there's no commission there, but you can be maybe a little bit more aggressive in their purchase because they don't have a home to sell. For those of you who are working with buyers who are deciding to keep their home and converting it as a rental property, you want to make sure that they talk to us early so that we can set up the financing so that they can be aggressive on their purchase. And then we are also helping quite a few people who are downsizing, who might not need to sell their home. So again, let's just say you have a buyer who's selling a house for like 1.2 million, and they may be downsizing to 600,000 as a condo. Those people still need to talk about their financing. But it puts you in a unique position where you can be a little bit more aggressive on the purchase. Just wanted to check the time to make sure we're on track, and we are. The fourth question is that you as a realtor would ask your client is, did you supply income confirmation for your pre-approval or approval? I can tell you that most buyers are a little slow with income confirmation. We find that, and we're mortgage professionals. Many of your clients may have been on CERB or reduced income, so we need to sort that out. Oftentimes, clients are a little tardy at providing letters of employment. We often ask for letters of employment up front. And then also you should know that letters of employment will be asked for, so let's just say we do a pre-approval for somebody in September 2020, and they finally put an offer on a house. they will need to provide another letter of employment, because the letters of employment and matching, and there has to be matching pay stubs. Actually, I was just reading an interesting article about mortgage fraud this morning in the National Post, about how we're starting to, and I'm seeing it at my office, how we're starting to see more fraud related to employment, because people are having to buy higher priced homes and they feel they can afford it, but the employment verification does not match with what they feel they can afford, right? So letters of employment and matching pay stubs. And we often call the letters of employment that we get initially just to confirm employment. And the reason why we do all this extra due diligence is so that you as a real estate agent don't have a problem when you're putting an offer on a house and the financing doesn't go through. I also wanted to let you know is that lenders will call within a week of closing to confirm income. So we always need to be in constant communication with our buyers, at least we do, to make sure that you know they haven't changed employment or even let go of their job. But I also want been let go from their work. I also wanted to let you know that there is always we can almost always get somebody a mortgage. It might, if you have a buyer that's in trouble who's put an offer on a house, we could probably get that purchase closed, and then maybe look at some financing down the road to help them, because usually that alternative financing is not the long-term solution. The other sort of thing that you want to, thanks Laura, I noticed you raised your hand, and I'll answer your question in a minute. I just want to get through this. The other thing that I think is really important is that we have lots of self-employed people that we're working with. So watch out for you is self-employed person who don't have their taxes completed for 2020, right? Or seem disorganized or brag about what they make. I do find that those buyers typically have issues with confirming income, and I come across that all the time. So we help lots of self-employed people who don't show a lot of taxable income. Sometimes those people do get frustrated because what they feel they make. So we're working with a client right now whose gross income is about $250,000. It's a sole proprietorship, but they only show that they net $20,000 in taxable income each year. So the question is, okay, well, what's the lender going to take? The $250,000 or the $20,000? Unfortunately, the bank lenders will look at only the $20,000. At the Mortgage Center, we have some really good alternative lenders that will allow us to sort of do a hybrid. And the last question that you want to be asking is, who are all the people or parties that are selling and buying? And I can tell you why this is important is often what you'll find is that we're dealing with more and more people who are going through separation and divorce. And you want to make sure that you understand all of the parties who are listed on the title of the property that you're selling. And, you know, there might be a spouse, right? But there also could be co-signers. And bridge financing can be impacted if there are different sellers and buyers. Okay, so for example, we're working with the clients right now who are selling their matrimonial home. And obviously the two parties have gone and bought other properties. But in order for the bridge financing to sort of go through, because their closing dates are not the same, the owners of the matrimonial home have to sign off on the bridge financing. Because remember, the bridge loan is a loan for the down payment. And if they're expecting the down payment to come from the proceeds of the sale of the house, if the parties are not in agreement in that, you may have issues with bridge financing. I also wanted to talk to you a little bit about co-signers versus guarantors. Co-signers, typically parents, they are actually registered on the title of the property. So the home on purchase is registered in tenancy in common instead of joint tenancy. So there are 100 shares in the property. And so your buyers, buyer A and B, like the couple, will be registered as 99% owners. And then their co-signer would have a 1% share on title. We do on occasion have people who want to be guarantors. So sometimes it's related to engineers or lawyers or people who are at high risk of being sued. So guarantors will not be registered on the title. So I wanted to point that out. And obviously when somebody calls us and they're selling a house, we have access to something called Purview, where we can do a search on the property to see who's registered on the title. Again, I think most of you are, I'm sure all of you are doing your due diligence to make sure that you do the searches that you need to avoid any title fraud. So I just wanted to kind of complete this part of the conversation, and I'm going to stop sharing my screen here so I could see you guys. I do have one question here, and I appreciate that. Oh, it doesn't look like there is a question. Does anybody have any questions? And if you do, you can sort of put them on the chat. But you know what? You guys are really cool. You don't have any questions. That's awesome. So let's keep going. Let me do a screen share for you. I hope I didn't scare you. Maybe that's why there's no questions. I hope not. So let me just X out of here. Oh, I do have a question here. That's great. Oh, thank you, Sabrina. Let's do a screen sharing here. And I'm going to get out of here for a second. And I wanted to, give me a second here. I'm going to exit out of here, and I'm going to switch gears a little bit, and we're going to look at a couple of interesting rate sheets. So as a mortgage broker, you know that we work with traditional financial institutions like TD and Scotia. We also have access to wholesale banks and alternative lenders. So I just kind of wanted to give you a little bit of a lay of the land on what's happening with mortgage interest rates so you can see. So one of the institutions that we actually work with is TD. Sometimes we can get actually a little bit of a lower rate through the broker channel than a client can do going directly to TD. The interesting thing about working with us is if a client is an existing TD customer and let's just say TD declines them, and we've had that situation just happen in the last week, we can place the borrower with an alternative lender and then the purchase can go through. So you can kind of see here what's happening with interest rates. You've got the posted rate. There are different rates. You can see here for a 5-year fixed rate on 25 and 30-year amortizations, and then also for rental properties. One of the interesting things about mortgages with TD, and this is especially true with clients who have variable rate mortgages, the TD mortgage prime rate is actually the highest out of all different financial institutions. So the current prime mortgage prime rate for most lenders is 2.45%, whereas TD's is at 2.6. So sort of something just to be cognizant about. You could see here there are some high ratio specials. So the interesting thing about TD and most financial institutions, for those clients who are putting less than 20% down and they're getting the insurance premium, their rates are typically just a little bit lower than they would be versus conventional financing. So that's TD. Let's look at, so we're starting to do more and more business with a company called Merix, and they're like a wholesale bank or a monoline lender. And one of the really interesting things about them is you can kind of see here that they do have some really great promotions. But the reason why I bring this up is I wanted to remind you that there are different categories. So you can see here that there are insured purchases and transfers. So these clients up here are putting less than 20% down and the mortgage is insured, okay? In this category here, insurable purchases and transfers, you can see here the LTV means loan to value. So this is the loan amount versus the value of the property. These clients are putting somewhere between 35 and 20% as a down payment, okay? And you can sort of see what the fixed rates are and the variable. P is 2.45%, so they're getting prime -1. The reason why I'm also bringing this up is, do you see here how it says uninsured purchases and refinances? These are the clients that will be impacted by the changes to the stress test rate. So this criteria are clients who are putting more than 20% as a down payment and require a 30-year amortization to be able to qualify the mortgage. Okay, so the stress test is proposed to go up, and it's going to be, right now, as far as I know, it's this change in the stress test is going to be these people. So those are your buyers who are putting more than 20% as a down payment on the purchase and require a 30-year amortization to qualify. Okay, that stress test rate is going to go up from 4.79 to 5.25. Okay, and that's the proposal. How it ends up impacting people, it varies. It could mean maybe they need to decrease their purchase price by about 30 or 40,000. It sort of depends, and that's why I'm saying to you is that for those people who you've had sort of in the pre-approval pipeline, who don't have an accepted offer yet, you should suggest that they sort of revisit their mortgage pre-approval, as that's exactly what we're recommending to clients. And then the last thing I wanted to sort of share with you is we actually do financing with alternative lenders. One of the lenders that we currently work with is called First National, and they actually have an alternative division called Excalibur. And so I wanted to show you what's happening on the interest rates for Excalibur because they're actually not that bad. So for those clients who have sort of so-so credit history, and remember, we can only have these clients. These clients have to have at least 20% as a down payment. So even your clients with poorer credit history, so FICO scores or Beacon scores between 650 and 678, they are still getting fairly decent interest rates. So they're not getting 2%, but they're getting like not bad interest rates. Okay. So that's what we're seeing with mortgage interest rates. And just to wrap up, I did want to talk a little bit more about the stress test rate and just kind of reiterate that. So the stress test rate, again, the proposal is that on June the 1st, for uninsured mortgages, so those mortgages with 20% down, or those purchases with 20% down or more, and clients who require a 30-year amortization, that qualification rate is going to go up by about 5.25, up from 4.79%. So for those folks who do not have an accepted offer or an approved mortgage, you want to make sure that they're revisiting their mortgage pre-approval. I am going to just answer, I noticed here that I've got a couple of questions here. The first question is from Christine Brady. So let's have a look here. She said, what would be the difference between a HELOC and bridge financing? Excellent question, Christine. So usually when we do bridge financing for somebody, especially if they don't have a mortgage, we normally do a combination of a bridge loan and a line of credit, or a home equity line of credit. And the benefit for them is that the interest rates on the secured line of credit are typically lower. And we usually do the secured line of credit on their purchase instead of the house that they're selling. And it kind of depends on the situation. So typically, the line of we would do a combination of a bridge loan with a HELOC if they are buying and they don't need a mortgage and they're downsizing. And the benefit of that is they have the secured line of credit after their sale closes, because all of the proceeds from the sale of the house is going to pay off the line of credit, and then they can have that and use that. So again, the main difference would be it's a little bit cheaper, the line of credit, and we would do the line of credit, the secured line of credit on their purchase. So that's one of the questions, and so I just thank you for that. The next question is from Christy Mercer. If there will be two people on title, but only one is signing the purchase agreement, can that cause any hiccups? I have not seen that. Usually what I will do is, because sometimes you might have people in different locations, okay? So for example, if we're helping a first-time home buyer here in Guelph, and they have a parent that's co-signing, and we've had that situation in like a Calouette. First off, you want to make sure you call the mortgage professional and make sure that they in fact are co-signing and have agreed. So what I would probably do is go ahead and get the offer accepted with the people who are local, and then you can add an amendment saying that we're going to be adding co-signers. I have not experienced any issues around that, but that's how I would normally handle that. So again, we do hundreds of mortgages here a year. We have not experienced any hiccups with that. So I think that wraps things up. I did want to mention to you guys that if you did appreciate this presentation today, I would ask you to do a Google review. You can just go to the Mortgage Center Guelph and do a review. I'd love your feedback on this. And then for any of you who want to do a follow-up appointment and talk to me about a specific client, send me an email, or you can go to my website at skipthebank.ca. That's skipthebank.ca. And online, there's a feature where you can just click and schedule a 15 or 20-minute consultation. We love working with realtors. We love working with realtors like yourself who are interested in education and information and helping your clients get ahead. Because I know when we work together in partnership with a real estate agent, the transaction for the person who's buying or selling, it is better for them and it's stress-free. So thanks so much. Have a great day, and I can't wait to connect with you again.